Kevin Matthews here, top 100 financial advisor, two-time author, one-time bestseller. I'm here to help you protect your 401k. It's a question I've seen in a lot of Facebook groups. It's a question I've seen a lot in my Instagram comments and on IG Live and Facebook Live. So I'm going to show you how to do that. As you can see, this is buildingbread.com. This is my site. You should go there, click free classes because I do this stuff all the time. Make sure you hit the share and like button as well. Now, the question is, how do you protect your 401k? Some people are saying, leave it alone, don't do anything. There's some merit to that. Others say continue investing. Some say rebalance. And then you got some who say just pull it out, go to cash, or just withdraw it and go pay off debt or something like that. Those last two are the wrong things to do. So I'm going to show you how to actually protect your 401k and what happens in times like these. So before we get to that, you need to understand the difference between stocks and bonds. Stocks obviously are shares of ownership in companies. Generally speaking, they tend to be more volatile, which is what we call the ups and downs that we're seeing in the market right now. However, they help to grow your money faster than a bank account, faster than bonds, and faster than other types of investments, usually. The other half of that coin is bonds. Bonds are loans that we give to companies and they promise to pay you back and they give you a set interest rate. The interest rate tends to be still usually higher than what you would get at a bank account. In your 401k, you have the option to buy stock funds, which are mutual funds that invest in groups of companies. So instead of just buying one company or two, you can have 500 or 1,000 or even 2,000. Those are called index funds. So to invest in an index, hundreds and hundreds, sometimes thousands of companies all together for one price. Very efficient, very good 99% of the time. On the opposite side, you have bond funds, which invest in hundreds and hundreds and hundreds of bonds. Now, they move usually in opposite directions. I like to say that stocks are the pedals. If you're on a bike, they help you go fast, and brakes help you to slow down. So when things aren't as great, when everybody's losing money, bonds usually tend not to lose as much money as stocks. That means the stock market goes really far down, the bond market's like, I'm not going to go that far down. So it's okay to lose money from time to time. However, if you're going to lose, you want to make sure you got brakes on your bike. You want to make sure you have a helmet, shoulder pads, all of those things. That's what bonds are. So when the market recovers, you can recover a whole lot easier if you have some bonds in your portfolio. Now, here's the thing for your 401k. That ratio of stocks to bonds really determines how well you're going to do in the future and how much wealth you're going to have. People who are older, meaning 40s, 50s, 60s, you want to have more in bonds than someone who just started their career in their early 20s, late 20s, and 30s. So we call this asset allocation. That is the technical term for it. So I'm going to move to the whiteboard to show you some important things between the two and how important it can, or how big it can have an effect on your portfolio. All right. So let's hit the whiteboard here. All right. So these are, again, portfolio allocations. That is a technical term for it. And right here, we have a portfolio that is 90-10. So in this one, this is 90% stocks and just 10% bonds. This is for someone who is generally younger. You just started your career. You are aggressive. This is for someone who's aggressive. You say I'm an aggressive investor, then you're probably in that 90-10 range, and that's okay. Someone who is a little less aggressive right here. So blue is the stocks, and we have red is the bond. So this person is 60-40. Not too aggressive. This is somebody who is probably mid-career. So let's say 50s, 45, 50 maybe. Okay, so that's who this person is. And then down here, this person is flipped where they are 40-60. And this person is conservative and close to retirement. All right. So we have 1, 2, and 3. And what I did is this is called a test. This is what I always teach my classes and everything that I go through. I teach them how to test their investments. So this is test is from 2000. Actually, we can go down here from 2001 to 2020. So how well would you have done in each of these scenarios? How well would you have done if you were a 90-10 investor? How well would you have done if you were a 60-40, if you were a 40-60? Okay. So this is what that means. In 2001, remember that we had the dot-com bubble. So I'm going to do this too so you guys know what's what. So let's do this. Blue. You get blue. It's not the same shade of blue. We'll be okay. This blue was the 90-10. This red was the 60-40. And I don't have orange, so I'm going to go with green. We got to deal with it. This green was the 40-60. Okay? That way you know what these lines mean. All right, so 2001, 2002, that was the dot-com bubble. Everybody lost money, okay? You're not going to be perfect and make money every single year. So don't be shocked by that. So here we go. Guess who lost the most money? That 90-10 person, that aggressive person, they lost the most money during that period. And as you can see, aggressive investors, when the market is down, they are down the most. So what does this mean? This is telling us that one, out of the past, was that 19 years, you've only had 1, 2, 3, 4 down years. 4 down years out of 19. That's not bad. That's actually not that bad at all. Okay. And then some of these losses, like here, and this is the year's not even over yet, some of these losses aren't even that big. Okay. So 4 down years, but aggressive investors tend to lose more. That means that you don't want to be aggressive when you're closer to retirement. And that's what I'm always telling people, especially your 401k. If you start your career, when you start at 20, 25, 30, whatever, you don't want to stay at a 90-10 mix, because what you don't want to do is retire in this year. What you don't want to do, especially, and this is what happened in the Great Recession, is that people were in that 90-10 portfolio and it was like, oh, I retire in 5 years. Well, guess what? You lost the most money because you were too aggressive. When you're younger, that's fine. You can tolerate this. You're going to be okay in time. However, the older you get, the more you want to move to be more conservative over the years. All right, so that's what happens. Now, also remember, you're more aggressive, more risk, more reward. So in these high years, you would have made a whole lot more money almost every time. And again, that's okay because you're more aggressive. You're not going to be able to switch from aggressive to super conservative to aggressive to super conservative because you're not going to know when these drops are going to happen. It's impossible. That's market timing. You're not going to be able to time those. If you sit out, you're not going to get anything. So you need to make sure that you are deciding where and how aggressive you need to be and at what times. Now, I'll tell you what to do at the end to suggest how you want to do that. But again, these are the things that you need to know. So if you're looking to protect your portfolio, you need to know what type of investor are you. I can't write and talk at the same time. That's your question. Are you aggressive at the 90-10 and you're willing to make a lot more money, but you're also willing to lose more money in times like this? That's fine if you want to do that. Are you someone who is conservative or right in the middle where you're like, okay, I'm decent. I'm not going to lose as much as everybody else. I'm going to be right in the middle pretty much almost every year. Okay, that's fine. Or are you going to be somebody who is really conservative and closer to retirement and you're really going to reduce those losses? You see how much money they didn't lose compared to everybody else? but they're almost never at the top. You notice that? Super small losses. Small gains too, though. This is the only year, 2011, for whatever reason, they made the most money. But that's only one time, or two times rather, they made the most money. Those are the trade-offs. You take less risk, you take less reward. Okay? So now, how much would these people have made during this time from 2001 to 2020? So this person, if you invested for all of these, I'm going to erase all this just to give you some more context and how we ran this experiment. So this was each of these investors. Each investor, I know the writing is sloppy. Investor. They started with 500 plus 100 per month. You can start that with a tax return, or you can do this really, really easy in your 401k, because that's what the topic is. So if I did this from 2001 to 2020, how much money would I have? If I was aggressive, I would have had about $7,000. This is the 90-10, right? 90-10. This is just aggressive, okay? And you took those losses too, but you got $7,000. If you were here, you would have gotten about $6,200. And this is actual data from that point in time with these two investments. And this was 60-40. I would say this is medium. And then this is conservative. We're going to erase this. You would have only had 5,500. And this is 40-60. And that's conservative. So that's what would have happened if you put in $500 a month. You start with 500, put in 100 per month. These are the numbers that you would have had during this period. So this only shows a year over time. The aggressive investors are going to win over time, but you don't want to be aggressive when you're retiring, because you don't want to retire in a year like this. You don't want to retire in a year like this because you were really aggressive. You're going to lose the most money. But this is also why you want to start early. Someone like my son, who is very young, someone in their 20s, they can afford this risk because they've got 1, 2, 3, 4, 5, 6 years for that money to come back. If you're if you're older, you may not have however many years for that money to come back. You may not have that. So the closer you get, the older you get, the closer you want to get to this conservative spot. So everyone, when you're young, you want to start up here and work your way down here at some point. That's how you protect your 401k. You need to have stocks and you need to have bonds. Let me get back to our regular screen here. That's how you protect your 401k. You have to have stocks and bonds. And notice the person who had the most bonds, those conservative investors, they did not lose nearly as much as everybody else every time there was a loss. But also know there wasn't that many years with losses. I think there were only 4 out of the past 20 years. And each time we did recover. So that's how you do it. How do you know what type of investor you are and all that kind of stuff? Go to buildingbread.com/webinar. And actually, if you hit the free class button here, or if you scroll down, you can hit the webinar button right there. And I have a free webinar, free class that I'm doing today. I do these classes like every day. So I get on Facebook, I talk about it, and then I jump off and make sure I'm in my class. You can ask questions and everything there. But go there and I show you how this works. I usually teach for about an hour, sometimes hours and change, depending on how long questions are. And I show you how this works. And again, there are easy ways for you to do that. In time, you're going to be fine, but that's how you protect your portfolio. It's not about pulling out. It's not about withdrawing. It's about understanding the stock to bond ratio. It's called asset allocation. So that's how you protect your portfolio. Thank you guys for coming out. Do not be too aggressive when you are older. you can still invest. You should still be investing. You should still leave it there. You just want to make sure that you have enough brakes, that you have enough pads and helmet on. Those who are younger, you're going to be fine. You can continue being aggressive, but make sure you go to buildingbread.com/webinar, click the webinar button right there. I'll make sure it's in the link, and I will see you guys later.